Dear friends of elections, the US has already a plan to become the biggest crypto superpower. Continue to watch this video to understand the current obstacles, future plans, and the chances for their plans to actually succeed. As Donald J. Trump assumes office following his re-election, a coalition of over 20 prominent attorneys in the crypto space has laid out a comprehensive plan to position the US as the world's foremost hub for blockchain and digital assets. This group, referred to as the Board of Crypto Directors, has outlined specific legislative reforms across multiple areas of law. Their recommendations address current regulatory obstacles that have driven innovation abroad and propose forward-looking policies to attract global talent, investment, and innovation. With Trump's public commitment to making the US the crypto capital of the world, this roadmap holds the potential to fundamentally reshape the country's approach to blockchain technology. As currently, like I just mentioned, there are currently obstacles that are holding the US back. As in the US, there are several legislative obstacles in the crypto sector, which conflicts with laws that stifle innovation. These challenges primarily stem from 6 key areas. The first area is security laws. US security laws are ambiguous regarding whether and when digital assets qualify as securities. The Securities and Exchange Commission has applied its rules inconsistently, classifying some crypto tokens as securities while leaving others in regulatory limbo. For instance, if a decentralized token is used for governance on a blockchain protocol and lacks a central issuer or a clear expectation of profit, it may still be treated as a security. And this inconsistency discourages companies from operating in the US and pushes them to jurisdictions with clearer frameworks, like the European Union MiCA regulations. The lack of uniformity prevents startups and developers from innovating without fear of enforcement actions. This brings us to the next point, which is financial market infrastructure laws. The lack of legislative support for tokenized financial assets, like for example stocks, bonds, or real estate, on the blockchain prevents the US from leveraging blockchain's potential for improving liquidity and settlement efficiency. For example, tokenized real estate could enable fractional ownership, making high-value properties accessible to smaller investors. But outdated infrastructure laws make it difficult to implement such innovations. Moreover, tokenized financial instruments, which could trade 24/7 with near instant settlements, remain largely unrealized due to a lack of regulatory clarity. Also interestingly, corporate governance laws also seem to be a legal challenge, as currently corporate governance frameworks are not designed to accommodate decentralized autonomous organizations, or in short, DAOs, which are increasingly used to manage crypto projects. DAOs often pool funds and allow stakeholders to vote on key decisions via smart contracts. However, under US security law, such entities lack formal recognitions. For instance, a DAO managing a decentralized finance DeFi platform cannot open a bank account or sign contracts with vendors, which significantly hampers its operation. What is also very important for crypto to be really implemented, there have to be more clearer banking and custody laws, as crypto businesses often face difficulties accessing banking services due to regulatory unclarity. Traditional banks are hesitant to offer custody services for digital assets, leaving many companies reliant on less secure or more expensive alternatives. For example, a US-based stablecoin issuer might struggle to find a bank willing to hold its reserve, forcing it to use overseas institutions or unregulated options. This lack of banking support puts US businesses at a competitive disadvantage compared to those in jurisdictions with more clearer rules. What is also often forgotten are smart contracts and blockchain laws, as the absence of laws specifically governing blockchain and smart contracts creates significant legal uncertainty. Smart contracts, which are self-executing agreements encoded on a blockchain, lack enforceability under current US law. For instance, if a smart contract automatically executes a payment upon delivery of goods, but one party disputes the terms, it is unclear whether courts would recognize or enforce the contracts. This undermines trust in such technologies and discourages their broader adoption. And this poses a couple of questions. First, but how can the proposed laws transform the US standing? Well, like I mentioned earlier, the crypto board has proposed targeted reforms in those 6 key areas, aligning with US laws and the reality of a new blockchain era. These reforms aim to establish a favorable environment for crypto innovation while maintaining necessary safeguards. So let's take a look how these areas can be improved with the new measurements. First, starting with security laws, the proposed reforms aim to clearly define which tokens are considered securities. For example, a governance token used to vote on decisions for a blockchain project without any central issue or profit expectations could be classified as a non-security. This clarity would attract projects to the US, enabling startups to operate confidently without fear of unclear regulations or sudden legal actions. Next are financial market laws. The US could enable tokenized versions of traditional financial products like stocks, bonds, or real estate, making them easier and faster to trade. Imagine owning a token that represents, for example, part of a building in New York. This token could be traded at any time without transaction settlement, almost instantly. Such innovations would bring more investors into US markets, enhancing liquidity and efficiency, while the market in the US could be leading in financial technology. Up next are corporate governance laws. DAOs are important for society because they allow people to collaborate and manage projects in a decentralized and transparent way. By using blockchain technology, DAOs enables communities to pool resources, vote on decisions, and automatically execute actions through smart contracts. For example, let's take a group that could form a DAO to fund local renewable energy projects, where every member has a say in how the money is spent, and all transactions are publicly visible. This can create trust, reduces administrative overhead, and makes it easier for people to participate in impactful initiatives, fostering innovation and collaboration on a global scale. Also, finding solutions for banking and custody laws is also very important if the US really want to become the next crypto superpower, as banks would be required to work with crypto companies and securely store digital assets. For example, a stablecoin issuer could keep its reserves in a US bank under clear regulations, ensuring transparency and stability. This would build investors' confidence and provide US crypto businesses with reliable banking options, reducing their reliance on overseas services. And finally, we have the smart contract and blockchain laws. Blockchain technology benefits society by enabling secure, transparent, and efficient systems for transactions and record keeping. For example, using blockchain in supply chain ensures that every step from manufacturing to delivery is tracked and verifiable. This increases trust between buyers and sellers while reducing fraud and errors. Similarly, blockchain-based systems can provide individuals with access to digital identities, or financial services, empowering underserved populations and fostering economic inclusion. However, all of this is of course very dependent on Donald Trump's commitment to making the US really the next crypto capital of the world. Most importantly, there seems to be a trend as the majority of crypto politicians in the US are now pro-crypto, which creates a favorable environment for legislative changes. And this bipartisan support could expedite and implement laws a lot faster. But finally, what are the most important takeaways? Well, first, the regulatory immobility and outdated laws across securities, financial markets, property rights, corporate governance, banking, and blockchain technology stifle US crypto innovation and pushes businesses abroad as of now. However, there are proposed reforms that aim to clarify token classification, and the goal is to enable tokenized financial products, grant legal protection for digital assets, support DAOs for decentralized collaboration. But this, of course, would require banks also to secure digital assets and promote blockchain use for transparency, efficiency, and inclusion. And as a final statement, a lot will depend on the ambition to implement laws and the time passing by to implement them. Generally, the US, in my opinion, is generally very fast and interested to revolutionize new technologies. So I expect a relatively quick implementation. But now it's time for you. What do you think about the proposed laws? Do you think that maybe even some of the laws are missing? Let me know. As usual, you can check out my previous videos that are recently uploaded. That's it for today. I will see you in the next video.